Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So I'm currently doing a bit more research onto different sectors within the S&P 500, and what I'm trying to do is find sectors that are still underperforming the overall indices. So for example, I'm comparing different sectors with the S&P 500. So the S&P 500 right now is up about 20%, I think I will say, and I want to see what sectors have not done as well as the overall markets, and what the ones that are still lagging and so on. Today what I'm going to do is I actually picked probably the one that is up quite a lot, and that's technology sector. So I picked 5 different companies that Wall Street are basically saying right now is a buy according to Wall Street using Seeking Alpha. And I'm going to share with you guys what basically the Wall Street is saying, as well as of course what is on Morningstar valuation, because I do really rely on Morningstar valuation a lot. And the reason I do that is because it kind of gives me the margin of safety. So I normally try to add another 5 or 10% on the top of what they've suggested, and normally that has worked out for me for the last 5 years. So inshallah, I'm going to continue doing that, and I'm going to share with you guys these 5 companies. They're all technology companies, like I said. All of them are buy rated right now by Seeking Alpha and Wall Street, and I'll share that information with you guys. As always, if you're enjoying this type of content, like I always said to you guys, it takes a lot of time and effort to put these videos together, and I would genuinely appreciate if you can just press that like button. That's all I ask, okay? And if you can join us at the Patreon account where you get access to a lot of things, like I've always said to you guys, I would appreciate that. But again, if you can't do that, just do what I just said. Press that like button, subscribe to the channel. Let me know if you have any questions. And as always, inshallah, I will try my best to continue sharing my journey with you guys, inshallah. So I was just looking at the this ETF, and this is the Vanguard Information Technology Index that tracks and a lot of the technology companies. And as you can see, a year to date is actually up about 13%. Sorry, for the last 6 months. And a year to date is actually up 24%, which is quite interesting. So you might be thinking, how are we finding value when this is up a lot? So I'm looking at all the sectors, and inshallah, I will share with you guys as much once I get more information about each one of these things. But what I'm going to do now is share with you guys 5 companies that are currently undervalued or fairly valued according to, or buys basically according to Wall Street. And the first one we're looking at today is Salesforce. Salesforce is one of the companies that's down quite a lot. Year to date is actually only up 10% in comparison to the 20% or whatever of the that's the 20%, that's the S&P 500 right now. And as you can see, for the last 6 months is actually down quite a bit, and Wall Street is actually saying it's 25 strong buys, 14 buys, 10 holds, and 1 sell. And when you look at their earnings expectations, okay, we're looking at double digits every single year moving forward, which is when it comes to EPS, and when it comes to revenue, almost double digits. Now, going back here, you can see it has a 275 billion market cap. It has a wide economic moat, currently trading $287 per share. They do pay small dividend, but we can't actually judge that yet. Okay, we're going to have to wait for a few more years, or at least until the end of the year. And then the 5-year growth rate when it comes to revenue and when it comes to EPS is absolutely amazing. The profit margin, return on equity, and return on invested capital, it's decent, okay, the 10% and above, that which is quite nice. The free cash flow right now is absolutely amazing. $11 billion of free cash flow, 11.46, which is absolutely amazing. And the compound annual growth rate for that EPS, for that free cash flow is right now about 29%, which is absolutely huge. Total return in the last 10 years, we're looking at about 17%. Growth estimate next year, 10%, 16% every single year moving forward. And according to Morningstar, it's actually fairly valued. So $290 per share. So they kind of agree with each other, which is quite nice to see. The second company I'm going to talk about today is Qualcomm. Qualcomm is not a high growth company, but look at this, growing double digits, expected to grow double digits moving forward. And looking at the price wise, 16-17% up for the last basically year to date, and the last 6 months about basically flat, almost haven't done anything. And forward PE, we're looking at about 16. This is where it has been trading for quite some time. When I was buying this stock, it was around this time, so it's becoming really interesting again. But as you can see, we've got it, it's a buy from Wall Street, and as you can see, we've got strong buys, 14, 7 buys, 15 holds, and 1 strong sell, and they're expecting about 28% upside from where we are. $217 per share is basically where they think the price should be. Now looking at the earnings expectation moving forward, we got double digits every single year moving forward, with revenue so about 7, 8%, 9%, which is absolutely amazing. Now they do pay some dividends, okay, so which is quite nice. And they have been paying that dividend for quite some time, 20 years, 5 or more years. They will become a dividend aristocrat. 80% safety, which is absolutely amazing. Now, revenue side of things is amazing, but the EPS has not grown much in the last 5 years, in the last 10 years. Sorry, last 5 years. Profit margin, return on equity, return on invested capital, absolutely amazing. 23, 38 and 25%, which is absolutely amazing. Now $12 billion of free cash flow, $12.56 billion, and that compound annual growth rate for that free cash flow for the last 5 years is about 21%. Now total return in the last 10 years from this, and when we say total return, we're talking about dividends as well as, of course, price appreciation. It's about 10% total return to investors every single year. Growth estimate next year 10%, 13% after that, which is absolutely amazing for the following 5 years. There was a time where this company was actually people were saying, and that was about a year or 2 years ago, people were saying, basically analysts were saying, okay, there is a negative growth moving forward, and that was the time I was buying a lot. I should not have trimmed it, but of course I took some profit off the table. I used to own 40 shares, I think it was, and I've got now about 30. Fairly valued, again, according to Morningstar, which is quite nice to see, $180 per share. Normally I'm quite skeptical about Wall Street, but the fact that, you know, Morningstar is also saying it's fairly valued at the moment, $180 per share, and right now is only $170 per share, which is quite nice. And the next one is Adobe. Adobe is definitely undervalued. It's been undervalued for quite some time. It has a huge market cap, $223 billion, wide economic mode. Of course, they don't have any dividends. But when you look at the growth side of things in terms of EPS and in terms of revenue, absolutely amazing. Again, profit margin, return on equity, return on invested capital. There's not many companies that can do that. $6.5 billion of free cash flow right now. Compound annual growth rate for that free cash flow is 11% and 22% total return in the last 10 years, which is absolutely huge. Now they're expecting the earnings to grow about 12% and 14% respectively over the next 5 years, which is quite nice. 20% discounted right now, $635 per share is where they think the price should be. And a year to date is actually down a lot. And as you can see, Seeking Alpha is a buy, Wall Street is a buy, Quant is actually buy. All of them are saying is a buy right now, and it basically 15% down year to date. When the last 6 months about 4% up, which is quite nice to see, and 27 PE forward PE, that is. Okay, now let's look at the ratings for this company. And so 19 strong buys, 8 holds, 2 sells, and 1 strong sell. And they're expecting basically the price to be about $612 per share. That's about 21% upside from where we are right now. If we're looking at the earnings expectations moving forward, double digits every single year, and then double digits every single year for the revenue, which is absolutely amazing. I really like this company. I do own it again in the family portfolio. I keep saying the family portfolio. You guys probably know by how many stocks I own in that family portfolio. But you join us in the Patreon account. Genuinely, if you join us, you get access to the family portfolio, of course, and you'll get access to all the stocks that I share and all of that stuff, inshallah. That would be absolutely amazing to have you there if you can join us. Now, if not, just press that like button because it takes a lot of time to put these videos together. Next one is ServiceNow, okay, 189 billion market cap. It's very similar to Salesforce. It has wide economic mode, currently trading $917 per share. I wouldn't be surprised if they actually if they not go. I wouldn't be surprised if they don't. If they do. What is it called? Stock split, okay, very soon, because this seems a bit expensive. Although you can buy fractional shares, I think people recently started getting into stocks. I was looking at yesterday Lamb Research, and actually they've done a stock split. Now it seems a bit more tempting to buy than it was when it was at 800 something, whatever. The 5-year growth rate for this in terms of revenue, in terms of EPS, absolutely amazing. Profit margin, return on equity, return on invested capital is really good. Free cash flow, $3 billion. Free cash flow compound annual growth rate for 32% for the last 5 years. Total return, 31%. Growth expected for the next years, 20%, 22% after that. Fairly valued as well, again, which is really good. $840 per share. It's way higher than that, but about $30 higher, or whatever, closer to $40 higher than, I can't even do the maths, $80. So what's it? yeah, closer to $80 higher than where it should be. But I'm sure this is quite volatile stock, so potentially might come back down again. Now if we look at Seeking Alpha, as you can see, it's a strong buy, okay, out of all the companies that we looked at now. But year to date is up 30% and 21% in the last 6 months. So if we look at the strong, what this says, 26 strong buys, 11 buys, and 2 holds and 1 sell, a strong sell, and basically see it's about 5%, 4% downside from where we are right now. $877 per share is where they think the price should be. Expectation is moving forward for this company. Again, high double digits, was just absolutely amazing for the next 5 years. Absolutely amazing. Next 3 years at least, if we just focus on for the first 3. Again, high quality business, discounted right now, both by Seeking Alpha and Wall Street, as well as, of course, Morningstar. Now, the next one is Autodesk, another company that we've spoken about not long ago. 58 billion market cap, wide economic mode. Right now, it's trading $271 per share. No dividends. But when it comes to the 5 years, when it comes to revenue as well as EPS, absolutely amazing. Profit margin, return equity, return investor capital, really, really good. And $1 billion of free cash flow right now. It's 58 billion. I would expect maybe about $2 billion of free cash flow, but that's absolutely fine. And when it comes to compound annual growth rate for that for that free cash flow, we're looking at about 8%. Total return in the last 10 years, 17%. Growth estimate next year is about 11. After that, 11% as well. Fairly valued again. All of these companies that we talked about, I know, you know, I've said Wall Street is actually a buy for Wall Street, but it's also Seeking Morningstar is also saying it's a buy. 275%, $275 per share right now. 271 is where it's at, so it's slightly higher than where basically it should be, which is interesting. Now looking Seeking Alpha, as you can see, it's just basically a buy right now. A year to date is about up 11%. Last 6 months about 10%, which is nice. Forward PE, we're looking about 32. It seems a bit expensive. If we look at this, we can see strong buy, 13 strong buys, 4 buys, 10 holds, and then about $292 per share right now. That's about 8% upside from where we are right now. If we look at the expectations for earnings expected, so almost double digits every single year for the next 3 years, and same goes when it comes to revenue side of it. So absolutely amazing. All of these companies are really doing great job. And by the way, this is the Sharia compliance side of things. You can pause the video and have a look at it for yourself. But all of them are doing really great job in terms of growth side of things. They're expected to grow really fast. They all seem fairly valued. So despite the market seeming really expensive, there are a lot of potentials. And if we see a dip in the market because of the, you know, the elections and everything that else that happens in October, remember November of last year is when the stocks basically start kind of going up, and we never looked back since. So we might see a dip in this basically between now and the 4th of November when the US elections start. So we will see what happens, but these are potentially companies that we can look into and do more research of, inshallah, moving forward. So in this portfolio, I own CRM. So I'm going to quickly show you guys, to be honest and transparent with you guys, the family portfolio. If you want to see it, join us on the Discord. You can see that for yourself. There you go. So I'm up about 18%. My current price is about average is $235 per share. That's the 5 companies I wanted to share with you guys. I hope you're enjoying this. If you are, please join us on the Patreon account where you get access to a lot of things. Have a wonderful day. Assalamu Alaikum.